Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything personal finance, and that sometimes relates to new products that you might want to consider investing in. Today, we're going to talk about a very specific product, that is the Specialized Investment Fund, and we're going to drill deeper and talk about one specific subcategory. Joining me today is Gaurav Mehta, who's the head of SIF equity for SBI Mutual Fund. Gaurav, thanks so much for taking the time. I'm going to start so that my viewers understand what we're talking about with a rapid fire FAQ, so that we're all on the same page, and then we'll delve a little deeper into the product that you're launching, I believe, in a couple of days, in a few days. So first, what is a specialized investment fund and what does it aim to do?
I think the key difference between a mutual fund and an SIF is that, obviously this is a category of funds within mutual funds, slightly different though, in the sense that this allows you to use derivatives a little more flexibility than you would do in a mutual fund. So the regulator has allowed up to 25% unhedged shorts in this category of funds. And in general, when you think of the usage of options and other derivatives, this is a bit more flexible versus what you see in the mutual fund, in the erstwhile conventional mutual fund construct.
Okay, and we'll delve a little deeper into some of these concepts, but this is just to set the context. Second, who can invest in this?
I think anyone and everyone can invest in this. The only difference between a mutual fund investment and an SIF investment is that the regulator has said that you have to have a minimum of 10 lakh rupees within SIFs of a particular AMC. So for example, if we're launching our first product initially that's going to be the only product to begin with, then you will have to invest with a minimum of 10 lakhs in the fund. But let's say at some point, if we have 5 such funds, then across those five SIFs from SBI Mutual Fund, you can cumulatively invest a total of 10 lakhs within those 5 funds.
Okay, and does that mean that if at all, because this is market linked, Gaurav, if that 10 lakhs that you initially invest in, for whatever reason falls to say 9 lakh or 9.5 lakh, do I have to make the difference up?
No, so if there is a passive breach which happens because of market movements, it's okay. But let's say if you've fallen below 9.5 and you want to redeem, then either you'll have to go to 0 or you will have to sort of maintain it at that. So you won't be able to redeem partly and let your investment fall below 10 lakhs. But if because of market movements it goes below 10 lakhs, that's all right.
Okay, you spoke about redemption. In a mutual fund scheme, you can redeem every day. When you get your money depends on the type of scheme. Either it's the next day or 2 days. What is the rule for SIFs?
So again, it depends on the category of funds. In hybrid long short category, for example, the regulator has said that it is an interval strategy. So to that extent, you can redeem 2 times a week. But from a subscription point of view, there is no limit. You can subscribe on a daily basis. And then there'll be certain other category of SIS where you will be able to both subscribe on a daily basis and redeem on a daily basis. And then there'll be some funds where the AMC may choose, depending on the regulatory construct of that category, to have an even less frequent redemption frequency. But for the fund that we'll be discussing today, it's daily subscription and 2 times a week redemption.
2 times a week redemption. Okay. Last question before we head into the conversation about this product. There are 3 broad subcategories for SIFs or SIFs. One is hybrid, one is equity, and one is fixed income. All of these have long short. Is that how it works?
Yes, exactly. So the unhedged shorts portion is the same across these categories. So which is what the regulator is saying is that you can go up to 25% in terms of your unhedged shorts. Doesn't matter whether it's equity, hybrid, or debt.
Okay. Now let's come to the crux of it, right? Because you're launching what is the Magnum SIF, and this is a hybrid long short fund. And seemingly a lot of your peers have also decided to go first into the hybrid category before they venture perhaps into pure equity or rather equity long short fund. Is there a reason why you've chosen hybrid first, Gaurav?
Right, so let me just also talk about the category first.
Sure.
So this category, from a definition point of view, allows you to largely invest in equity and debt as the 2 primary asset classes. And you have to maintain a minimum of 25% in each. But beyond that, you are free to within 25 and 75, it's up to you whether you want to be, primarily debt-oriented or primarily equity-oriented. From our point of view, the logic of launching this first was extremely simple. There is this general perception that derivatives are speculative and risky, and therefore SIF is for aggressive investors. We think derivatives can be used both to enhance risk and to mitigate risk. In this product, we are trying to use derivatives to hedge risk, to mitigate risk, and therefore come out with a very conservative kind of a product positioning. A conservative product is something that works for everyone. Whether it's an aggressive investor, they want to put some portion of their money in a conservative strategy, and for someone who's a conservative investor, they anyways want to invest in a category like this. And today, when you think of the current avenues that are available in the mutual fund space, if something which is debt oriented, which is stable returns, but the taxation is not the most efficient one there. And then you have something which is equities, which is good returns, but it has its own volatility and tax is a little better there. And then you have this category of funds in between called hybrid funds. And hybrid funds are where you have lower risk and volatility than equity, but a bit higher risk and volatility versus conventional debt. And in hybrid, people have tried to sort of optimize on taxation through various ways. But for an arbitrage fund investor, which is the other category that a lot of investors have started putting money in because it gets equity taxation and it has stable return profile like debt funds. For a debt investor, arbitrage has become the default choice today because hybrids, all said and done, still carry a degree of risk, which is not something that a lot of people are very, they don't have the appetite for. So we thought this gap between, arbitrage, where you generate tax efficient but low returns, to hybrids, where you generate decent returns but with a degree of risk, this was proving to be a big step for a lot of people to climb. So we thought there was a big need to have a sub step in between where you can target higher returns and arbitrage, but at the same time keep the risk profile limited. Obviously, it's going to be slightly riskier than arbitrage fund. It's not as risk-free. But versus conventional hybrids, this is going to be a lower risk proposition. So it's that in-between space that we are trying to fill through a conservative use of derivatives.
Okay, so you've explained this very well, but I have a few follow-up questions. First, to the point on the risk scale. In the document that I see in front of me, it is in a scale out of 5, reading as 2, which is, as you've pointed out, conservative. So that drives home the point. But I do want to ask you, in existing hybrid schemes in the mutual fund space, there are a few fund managers that choose to use arbitrage to supplement their equity holdings to meet certain thresholds. And as you've pointed out, arbitrage is lower risk. People are actually gravitating towards that from fixed income because it offers slightly better than fixed income returns, and the tax efficiency is better. Why can you not do what you're doing in this particular specialized investment fund in a mutual fund?
So I think I didn't actually talk about the product per se. What we're trying to do here is to get equity taxation. And as I said earlier, you have to have 25% minimum in each of these two asset classes, equity and debt. So from our point of view, the equity allocation is between 65 and 75, and correspondingly, the debt allocation is between 25 and 35. And then we've also allowed ourselves some flexibility on REITs and invest to the extent of 10% of the portfolio. But the way we are trying to manage risk, and which you cannot do in a conventional mutual fund, is that the 65 to 75% equity portfolio that we intend to build, we want to hedge out, or not completely hedge out, but at least offset or mitigate the risk by clever use of derivatives. So, if you want, I can go into the details of the strategy. But for
please do, because what I read in the presentation, you're basically effectively using both calls and puts in the options space to mitigate risk. You can explain that. If I have questions, Gaurav, don't expect me. Or rather, you can expect that I will ask you.
Perfect. So, the very simple way to mitigate risk, and which is something that we all do in our daily lives, is to buy insurance. In the stock market context, buying insurance against your equity ownership means buying a put option, so that when stock falls, you are protected on the way down thanks to the put option that we bought. But the challenge that we all face with insurance behaviorally is that we have to pay a premium upfront, and we keep paying that premium irrespective of whether the risk even materializes or not. And which is why when you buy put options to hedge out your portfolio, you end up paying a premium every month, which is something that eats into your overall returns. One way to mitigate that is to sell a call option against your existing stock and use the premium that you collect from selling a call option to fund the purchase of your put option. But what is the risk reward profile of such a structure? You have limited your downside thanks to the put option that you've bought. But because you've also sold an out of the money call option, your upsides also get capped. And if you structure it in a fashion that you end up with a net premium rather than a premium outgo, then you also earn some premium income every month. So when you think of a strategy like this, you've achieved two things. You've tried to get some premium income in every month, and B, you've reduced the variability of returns, you've limited your downside, and you've also accepted that that comes with a cost, and the cost in this case being that I'll also forego upsides in case of big market moves. So then your return profile essentially gets limited to a certain range. You don't lose beyond a certain amount of money, but the flip side is you don't also gain a certain beyond a certain amount of up move, and on a steady state basis you earn some premium income. And it's through this use of selling calls, buying puts that you're trying to manage the risk profile of the fund. Even though, as I said earlier, from a gross equity exposure point of view, we'll be 65% plus in equities. But through this cover, which we expect to run on a predominant part of our equity allocation, the completely uncovered equity portion is going to be extremely low, if any at all.
And therefore that would be, I read that it's between 0 to 10%. So that pure equity component will be less than 10% effectively, right?
It'll be less than 10%, and that's also something that we've kept for very opportunistic use. For example, you might have some special situation trades where merger is unfolding, and the two stocks or the two companies that are merging, while there is a predefined or pre-announced merger ratio, the current prices may be deviant from that. So you're just trying to capitalize on that by buying one which is cheaper, selling the other which is more expensive, and locking in a relatively, I won't say risk-free, but a relatively low-risk trade to block that difference in the current prices versus the announced merger ratio.
Yeah.
So those are the kind of opportunistic trades which we'll want to take also, and which is why we've kept that 10% leeway. But in no case will that 10% leeway be just taking directional equity from a 3, 6, 12 months point of view.
So
it's all going to be very short term, very opportunistic.
So therefore the question arises, you've talked about the fact that your downside is limited, but your upside is therefore, as a flip side and a consequence of that, also capped. What is the kind of range and expectation? This is not a fund that is meant for profit maximization. That is not the intention. So what is the kind of range an investor can expect? And of course, this is going to be equity-linked taxation or equity taxation, long-term capital gains after 1 year, 12.5% capital gains tax because it is 65% equity. But what is the range that one can expect?
So unfortunately, I'm not allowed.
No, you're not allowed to. Okay.
A specific number, but just to talk about it directionally, we do intend to add decently to what you get from a conventional arbitrage fund. We are also maintaining the equity taxation that you achieve in an arbitrage fund, and from a risk profile, we are still wanting to keep the risk significantly lower than your hybrid funds. So to that extent, both from a return as well as risk point of view, this will sit somewhere between conventional arbitrage funds and conventional hybrid strategies on the mutual fund platform.
Got it. Okay, I see that scale, and it's explaining the concept. My last question, Gaurav, and this is not something that often I think we speak about, purely because people don't get into the nitty-gritties of fixed income. But in your fixed income component, what is going to be the primary holding? Is it going to be government securities, or will you also venture into high-quality corporate debt?
Right, so I think the primary aspect of the fixed income strategy is to keep it less volatile, and to that extent, we won't be taking a lot of credit risk, and we won't be taking a lot of duration risk. So to that extent, this will be accrual-based strategy, which can be a mix of the best-rated corporate papers and government bonds. And also one sort of technicality here that whatever you do on the option side, you will need some margin for that. And if you own government bonds in your portfolio, that works well from a collateral standpoint. So to that extent, you will see a decent skew towards government securities, but also some some sort of best rated corporate papers on top of that.
Okay,
but no credit risk, no duration.
No duration. So therefore, the interpretation of that last statement would be that by and large, your duration is likely to be on the lower end, right?
That's absolutely.
And how would you define that?
So we haven't put in anything as such, but if you were to ask me, we want to keep it near 3 years or lower and not exceed that.
Fantastic. Gaurav, I think I've gotten quite a few of my questions answered, but I'm sure that if my viewers have more questions, they will write in. It's been an absolute pleasure speaking with you. Thanks so much for taking the time.
Pleasure was mine, and thank you so much, and thanks for the viewers for listening in.
All right. Well, there you go. So it is a concept that will take a little time to understand, understandably so, and that is usually the case for new concepts. But understand that a lot of asset management companies are heading out and launching this product first. A lot of people are actually going to hybrid long-short funds to begin their journey into specialized investment funds. Of course, as was pointed out by Gaurav, the ability to invest will have to be there in the first place. So you need to be able to put 10 lakh aside, and usually, as we've talked about in the run-up to today, it's not meant for individuals that only have 10 lakh to invest. You need to have cut your teeth and invested a certain amount of money over the course of your investment journey, and then you can look to diversify, and a portion of your money you can look to put into specialized investment funds.